It is almost 11 a.m. in Singapore and Shanghai. Welcome to Bloomberg Markets Asia. I'm Haslinda Amin. Here are the top stories.
The central bank policy rate will bring it down by 0.2 percentage points from the current 1.7% to 1.5%.
China's central bank lowers key rates in the latest attempt to shore up the economy. It's also unveiled a package to rescue the property market. The moves are part of a policy support blitz from Beijing, which includes steps to boost equity markets, allowing funds and brokers to tap PBOC funding to buy stocks. JP Morgan co-head of global banking, Filippo Gori, joins us later on the show for an exclusive interview on how he views China's new attempts to stimulate the economy. And we'll also hear exclusively from EQT Asia Chairman Jean-Eric Salata on the deal-making environment in Asia, especially in India, as well as in China. It is risk on in Asia. Asian stocks at two-year highs, but it is really about China and that bazooka of measures to prop up its economy and perhaps reverse the sentiment among investors. Cuts in rates and reserve ratio reductions to new capital and stock policies. The measures are huge and perhaps even unusual. China talked about creating a new monetary policy tool for the equity market. It will cut existing mortgage rates, also its 7-day policy rate. Take a look where it is in terms of the impact on the market. And here's PBOC Governor Pan Gongsheng with more details on the sweeping monetary stimulus measures.
We will cut required reserve ratio and policy rate and guide the market benchmark rate downward. Second, we will lower the mortgage rate for existing housing loans and unify the minimum down payment ratio. Third, we will establish new monetary policy tools to support the stability and development of the stock market.
Let's bring in our Chief North Asia correspondent, Stephen Angle, who's in Shanghai. Also joining us, Grace Tom, Chief Investment Advisor at BNP Paribas Wealth Management in Hong Kong. Steve, talk about giving it all, including the kitchen sink.
Yeah, that's right. This is the broadest push so far year to date by authorities and what the markets and many economists, analysts have been calling for, and that is broader policy support. You can call it a bazooka or not because we have to see how well this is targeted, but it is a very welcome move. We have stocks on the rise in Hong Kong and in China on these moves that address some real issues. Obviously, this injects a lot of liquidity, these moves by the PBOC and the two other finance officials, including the securities regulator, on a very rare stage today and basically laying out their policy priorities. So stocks are up. They also address some of the shortcomings in the property market. Keep in mind, back in May, authorities really unveiled a support package, but it didn't really filter out. Stocks sold off since May. Stocks have been down about 13% before today since May 20th after that rescue package for housing, which didn't really have a lot of efficacy. So now they're hoping with about 3 months left in the year and still with that growth target of around 5% GDP growth still in the sights, this will help push authorities past that goal of GDP growth of around 5%. What did they do? Well, they cut the policy 7-day reverse repo rate. That is the second time they've done that since July. This also follows the 14-day policy reverse repo rate cut that we saw yesterday. They also cut the RRR, the reserve ratio requirement for banks. That's the requirement that banks essentially have to set aside. So that adds liquidity. Pan Gongsheng, the PBOC governor, essentially saying this will unleash $1 trillion yuan, or 142 billion US dollars in liquidity. He also signaled going forward they could have more RRR cuts, more monetary stimulus, if the data suggests it is needed. So again, it might be called a bazooka. It is very welcome in the market right now. It is something that many market participants have been hoping for to boost sentiment, not only, of course, for liquidity, but for the stock market, because as you mentioned, there are measures as well for brokerages and other funds to be able to tap PBOC funds to invest in the stock market. So that's good. And it also addresses some of the mortgage concerns, homeowners who have lost about $18 trillion in household wealth in this years-long property crisis.
Steve, that bazooka is sending the Hang Seng China Enterprises Index more than 3% as we speak. The thing is, when you take a look at the CSI 300, it's up about 1.5% max. I mean, I'm not sure if there's still trepidation or investors are actually looking for more consumption, for instance, measures to boost consumption in China.
Yeah, I think a good barometer will be coming in the next week or two when the National Day holiday happens here in China. It's a week-long holiday. People have to feel confident to go out and travel, to spend as well. And right now, of course, the property market is still a falling knife that many households do not necessarily want to jump in. They're trying to incentivize it to lower those mortgage rates for new home buyers and also lessen the burden on households for existing mortgage holders. But again, confidence right now is clearly low. Retail sales have been just trending in very low single digits for many months. Corporates are also very reluctant to borrow right now at a time when deflation is having its longest streak in since 1999, 23 straight months of factory gate deflation. So there are some structural issues here that still need to be addressed. But again, these moves right now by monetary officials led by the PBOC Governor Pan Gongsheng are very welcome.
Stephen Angle, we thank you so much for that. The question remains, is it enough? Let's get to our guest, Grace Tom, Chief Investment Advisor at BNP Paribas Wealth Management in Hong Kong. Grace, your reaction to what we saw today, we call it bazooka, a blitz of support. I mean, how are you looking at it?
Yeah, I think it looks like a gift ahead of the National Day and the Golden Week. I won't say that's a bazooka, but this is, the monetary stimulus that is more than expectations. So that's surprise to the upside, and we've been seeing a bounce in the stock market. And of course, I think it also shows the government's clear intentions to achieve the 5% growth target, but also they have measures to support the stock market. I think that was also a surprise. And what happened today, I think it actually raised the expectations of more coming, especially for today is more on the monetary side. And I think market would expect there will be more announcement on the fiscal side.
So we're talking about more liquidity in the Chinese market. Is that enough to perhaps reverse the sentiment we've seen among international investors?
Yeah, I think, for today, the measures are actually, surprise to the upside. It's bigger than expected. I think that helped lift the sentiment a bit. But obviously, I think the market will see more is needed. As I mentioned, for today, it's more on the monetary side. It support liquidity, and they have new capitals to support the stock market. But for the real economy, whether all these measures could effectively help the real economy is still to be seen. And also on the fiscal side, like whether they are going to announce like another very big bond quota, things like that, or I think that also need to be seen. Yeah.
So, Grace, on the back of the measures today, are you looking at the Chinese market differently? Would you position differently for China?
I think for now, sentiment, would be, better, given, the surprise today, and I think we are going to see like a rebound in the Hong Kong, China stock market. But again, it's always the questions whether the rally is going to be sustainable, and that back to the questions whether the markets see the measures are sufficient. Yeah.
We've been talking about how valuations in China are very low, especially when you compare that to valuations in India, looking pretty much overstretched at this point in time. Would you be buying, for instance, the property stock, since we're beginning to see the support for the property sector?
Yeah, I think, of course, it's good to have like more poverty easing measures. But as you know, we have been seeing a lot of like poverty easing measures for some time, and the property market is actually still pretty weak. And I think we have to see whether all these new measures are able to at least stabilize the property markets. And I don't think we're really, fast enough to see like really like a V-shaped recovery in the property market. I think all this actually takes some time. Yeah.
Grace, in terms of the yuan, where do you see it stabilizing by the end of the year? We saw how the PBOC made a huge move to ensure that it doesn't breach the seven level.
Yeah, I think, with the PBOC actually planning to have like more rate cuts in the coming months, I think especially given the recent rally in the renminbi, we do think there could be some period of consolidation. So could be like consolidate at around like 7.1, 7.2, and indeed, I think the recent months of strengthening of renminbi actually, and plus, the Fed's 50 basis point cuts. This actually gives more room for the central banks, for Chinese central banks, to do more in terms of monetary policies.
Grace, hang tight. Grace Tom, BNP Paribas Wealth Management in Hong Kong, is sticking around. Still to come, we'll speak with JP Morgan's co-head of global banking about why they're turning bullish on India and Japan. Plus, EQT Asia chairman joins us to discuss the outlook for private equity in the region. Those exclusive interviews just ahead. Keep it here with us. This is Bloomberg.
If conditions continue like this, there are a lot of cuts to come over the next 12 months. There's virtual unanimity about that. So whether the next one is 25 or 50 or 0 or whatever, my view is over the next 12 months, we have a long way to come down to get the interest rate to something like neutral to try to hold the conditions where they are.
Momentous as the recent decision to begin removing restriction from monetary policy was, taking that step does not lock us in a cadence for further moves. I think it's important that no one think that we're in a mad dash to get to some neutral level. Given the amount of uncertainty in the economy, being more patient will be valuable.
Fed Presidents Raphael Bostic and Austin Goolsbee with views on the Fed's rate path. Grace Tom, Chief Investment Advisor at BNP Paribas Wealth Management in Hong Kong, is still with us. She's expecting 2 more Fed rate cuts this year and 4 additional cuts in 2025. Grace, why?
Yeah, actually for the U.S., a soft landing is still our base case scenario. We understand for now the market's still pricing in pretty aggressive rate cuts, for example, like 75 basis point by end of this year. But for us, we expect 50 basis point by end of this year because we still see the soft landing as our base case. And we actually have been seeing like a lot of economic data in the U.S. actually still pretty solid and resilient. And obviously for the labor market, it's softening, but it's not really something, for now we have to be really concerned about. For example, especially for the weekly jobless claims data, actually we've been seeing the trend of going down again.
Grace, it's not just about expecting a soft landing. It's also pricing in the best case scenario, perfection in fact. Surely some correction is coming for a market like the US that is so overstretched in terms of valuation.
Yeah, I think in terms of the stock market, obviously is hitting record high again, and valuations are no longer, reasonable. You can say it's a bit actually expensive compared to other markets in the world. But for now, in terms of the overall valuations, we would say, especially for the tech sectors or those like mega caps, they are, even after the correction, they're still a bit expensive. But for other stocks like the value sectors, value stocks, healthcare, financials, and those valuations are still pretty reasonable. So we still think, like any pullbacks would be buying opportunities for the U.S. equities, given more rate cuts is in the horizon, and that could mean more loosening in terms of the financial conditions as well as the global liquidity, and that should be supportive to the equity markets. Not only the U.S. equity market, but we see the global equity market will be supportive by the rate cut cycle.
That's right, including Asia. Should there be a rotation from the U.S. to Asia?
In fact, we do, still positive on the Asian equities, and especially, we expect the rotations, just started to happen. And given, with the rate cut cycle starting, we've been seeing the weakening in terms of the U.S. dollar, and all that actually will be supportive for Asian asset as a whole. And also, with the Fed started the cutting rate, we will be seeing the Asian central banks will also starting to cut rate. So that would be also very supportive to the Asian economies as a whole.
Right. But which markets in particular do you expect to be standout markets this year on the back of that?
Yeah, I think what's interesting to see is in the first half of this year, we've been seeing more like AI-related or semi-stocks in the North Asia, like Japan, Taiwan, Korea. They've been doing very well. But recently, we've been actually seeing some rotations to the Southeast Asian markets when those AI or semi-related stocks corrected. And we've been seeing this kind of like rotation, money going back to Southeast Asia, but overall we still think like the current rate cutting environment, and also the weaker U.S. dollar will be supportive to the Asian market as a whole, including China, and we continue to like India, Japan, and also like for example like Singapore.
All right. Asian Focus. Grace Tom, BNP Paribas Wealth Management in Hong Kong. Thank you so much for that. Plenty more ahead. Keep it here with us. This is Bloomberg. Welcome back. Lebanese officials say nearly 500 people were killed as Israeli forces pounded hundreds of suspected Hezbollah targets in one of the deadliest days of fighting since their 2006 war. Monday's escalation is stoking fresh concerns about a full-scale war in the Middle East. Bloomberg's Asia senior editor Bill Ferris joins us now. Bill, what's the latest on the attacks?
Well, Israel said it was targeting, or it went after about 1,300 targets in southern Lebanon. Lebanese officials saying at least 500 people have been killed. And Prime Minister Benjamin Netanyahu basically signaling that Israel does not want to be caught on the defensive the way it was October 7th last year when Hamas militants stormed into Israel. They said they want to essentially be taking the fight to Hezbollah. They've been encouraging Lebanese citizens living in the southern parts of the country or anyone living in a building or facility where Hezbollah is believed to be storing weapons to be moving immediately out of that area.
The question is, where do we go from here? We know Iran's president has come out to say he's willing to de-escalate the situation if Israel agrees. Are we likely to see that or not?
Israel has signaled its priority now, along with the battle against Hamas and its leadership, is to get its civilians, about 70,000 people who have had to flee the northern parts of the country, back to their homes, able to live there. That's going to require them continuing to go after Hezbollah in Lebanon. The two sides have been trading fire almost on a daily basis since that October 7th attack by Hamas. I don't think there's any realistic optimism at this point that there's going to be a breakthrough in any of the peace talks, regardless of what the Iranian president has said in New York.
Bill, thank you so much for that. Bill Ferris on the latest developments. Well, for more on global political stories we're following right now, Singapore's former transport minister has pleaded guilty to bribery charges after amendments to the indictment against him. As Iswaran entered the guilty plea as his trial began, a surprising twist to the city-state's biggest political scandal in nearly 4 decades. The prosecution proceeded with 4 charges of obtaining valuable items as a public servant and 1 count of obstructing justice. He had originally pleaded not guilty to 35 charges, including graft. The Biden administration is proposing a rule to block the sale and import of Chinese and Russian-made hardware and software for connected vehicles. The proposed ban aims to secure vehicles which can communicate externally through Wi-Fi, Bluetooth, cellular or satellite systems. Officials say these systems are at risk of foreign interference, which could lead to disruption and sabotage. Let's take a look at how it's looking for Chinese assets on such a big day for China on the back of that bazooka of measures to boost investor confidence as well as its economy, the cuts in rates, cuts in reserve ratio requirements, also new capital and stock policies. All these measures significant. Some say that it is a bazooka of measures. CSI 300 index continuing to pick up pace. It was muted at first, now up by more than 2%. The Hang Seng getting a lift. It is currently higher by more than 3%. In terms of the Chinese yuan, trading at 704.78. We're seeing a strength in the Chinese currency. Remember that the PBOC did come in to draw that line in the sand, not wanting the currency to breach that 7 level. And take a look where we are in terms of 10-year yield, currently at about 2. It did breach 2 for the first time ever. Again, China doing what it can, some say, including the kitchen sink, throwing the kitchen sink out there to support its currency, to reverse sentiment among investors, in particular international investors. It will create a new monetary policy tool for the equity market. It will cut existing mortgage rates. Also, all these moves in support of the economy. Well, coming up, we head back to JP Morgan's India Investor Summit. Bloomberg's Manaka Doshi joins us with a look ahead at our next exclusive interview. Manaka.
FIPO Gori, Global Co-Head of Banking at JP Morgan. Now we'll discuss the outlook for investment and growth and deal making, especially in China, given this morning's bazooka of stimulus measures. That's next. This is Bloomberg.
strengthened adjustment of and regulation of the monetary policy, making the policies more targeted. We have used a combination of policy tools to support steady growth of the real economy.
PBOC Governor Pan Gongsheng talking about China's sweeping new stimulus measures unveiled just a couple of hours ago. China's markets just heading to lunch, and of course it's had that boost from those slew of measures which perhaps have exceeded some investor expectations, measures to perhaps reverse investor sentiment, especially among investors internationally, also prop up its economy, not to mention prop up its property sector as well. We've seen how the property plays in particular have been given such a lift. CSI 300 index up by more than 2.5%. We have the yuan trading pretty flat right now, 704.21. The Hang Seng Tech index rising. Wow, look at that, about 4% right now. Let's get you back to the JP Morgan India Investor Summit in Mumbai. Joining us now is Filippo Gori, co-head of Global Banking and EMEA CEO at JP Morgan. Also with us is Bloomberg Senior Editor Manika Doshi. Filippo, always good to have you with us. Let's start with your reaction to the measures we saw out of China. Suddenly, unexpected in terms of scale.
Good morning, everyone. Haslinda, thank you for having me. Manika, very good seeing you as well. So I agree with you. To a certain extent, surprising, certainly welcome from the investors' standpoint. As you were mentioning in your own intro, the property sector in China definitely needed further stabilization and support. So I'm sure the investors are reacting very positively to this set of news. Overall, while I think the scenario is improving and that therefore there is probably a degree of optimism coming back into the China market right now, there is still the looming US elections in just over a month. So I think overall investors will want to wait and see also what happens after November before pouring back into the mainland.
Is it enough to ensure more risk-taking in the Chinese market, you think, Filippo?
It has surprised people on the upside for sure. Whether it's enough, only time will tell. There is an element of consumer confidence in the mainland that needs to be restored as well, and that doesn't happen overnight. So we'll have to see how this set of measures will translate into the real economy and how the local consumer will react. I think from my personal point of view, restoring consumer confidence among the local Chinese is probably more important long term than just creating a stimulus for the foreign investors.
Given the stimulus blitz that we have just seen, Filippo, I'm just wondering as well whether there's a sense that China is making, deflation its priority.
I don't know whether I would go that far. I'm not sure that the Chinese policymakers think about deflation in that sense. There could be a component of it coming that possibly could be even welcome to a certain extent, but I'm not sure that that's the real intent.
Filippo, how are you viewing the India growth story in the context of what's been happening to China over the last couple of years and, of course, this morning? And do you think India is doing enough to be able to get a fair share of the global value chain or supply chain that was put at risk over the last couple of years?
So India has done fabulously well, if you think about it, over the last decade or so. I've been in Asia Pacific for 11 years now, and it has been a constant growth story and a change that I've seen and witnessed firsthand myself. Over the last couple of years, definitely India has been one of the main beneficiaries of the China Plus One rhetoric and supply chain shift away from the mainland. And earlier this year, we have definitely seen an influx of investors, positive sentiment towards China. Even if the elections outcomes ultimately were in line with were probably at the beginning not in line with the expectation, but they have turned up to be positive for the country. There's been a constant trend of people being positive over India. And if you look at it in a global context, the Indian equity market is the only one that is actually active from an IPO standpoint, because the rest of the world, from a pure IPOs, it's actually quite tough. And while India is definitely in that context very positive. So to answer your question, India remains definitely the service economy of the world, and it's gained a component of manufacturing as well, further away from the mainland, and I think more will probably come.
And yet, Filippo, we've seen, a very low inflow of foreign direct investment in India. And in fact, when you look at the equity markets, despite the crazy bull run that we've had over the last couple of years, foreign ownership as a whole of Indian listed stocks has declined over the last decade. So how do you look at the construct of the structure of the Indian equity market, and where do you see it going from here?
So definitely there is a component of complexity associated with the Indian market that at times makes it complicated for foreign investors to get their heads around. There is an element of that. But if you look at it for instance, from a JP Morgan standpoint, we have been growing our presence in the country enormously over the last decade or so. India is currently the location outside of the US with the largest number of employees, which is almost 60,000. We have opened 2 new state-of-the-art campuses, one in Mumbai and one in Hyderabad. So we have kept investing locally now for 79 years, but definitely in the last decade in a very positive way, because we see the benefit of being invested in India.
Filippo, amidst all the optimism, is there a risk in investing in India? If you take a look at the equity markets, for instance, driven by, retail investors and even the regulators that come out to say, wait a minute, be careful, don't get burned. Is there a risk in investing in India?
I wouldn't know whether there is. I wouldn't never say that there is a risk of investing in India the way you put it. I think there is an overall set of concerns that we have as a firm more globally that applies to, let's say, to every country around the world. There is definitely a component of, we are concerned that inflation might be stickier than people globally are set to imagine. Some of the global trends that we see, think about, and you just spoke about it, the conflicts in the Middle East, or the Russia-Ukraine conflict, or some of the other trends that are inflationary in nature. There is a fear that stickiness might play out maybe in the second half of next year. And if that therefore plays true, is there a sense that some of the equity markets might have run ahead a little bit of a valuation that take into account this risk, which is geopolitical in nature, inflationary in nature, and so on and so forth.
Filippo, how are you assessing the opportunities for deal-making in India in sectors like healthcare, AI? Where are you with that?
So there are some important themes in the country. So we are number one 2023, 2024 year to date. We are number one player in the country. There are definitely some themes that are the ones you mentioned. I would say also themes of consumption, India for India, export, India for the rest of the world, infrastructure, and so on and so forth. There's definitely been a flurry of activity that makes India a super exciting place where to have a large team on the ground and to help both global clients coming into the country, local clients playing in the country, and local clients who also have ambition abroad.
You mentioned, Filippo, that India is a complex market, no doubt about that. What more do you think we can do to be able to attract not just newer foreign direct investors, strategic players, but also foreign portfolio investors in both equities and bonds?
I think a lot of it has been done already over the last decade or so, and then continue on that path of simplification of the rule-making, which at times can be a little bit arcane and so on and so forth. Everything that you can do to make the process smoother and simpler will definitely help in bringing foreign investors into the country.
And one quick last question from me, Filippo. You mentioned India was your second largest employee base outside of the US. You know, are you looking to add to that in terms of numbers over the course of the next couple of years? If you can give us any kind of guidance on that.
Yes, we have kept investing. We keep on growing in India across the various locations that where we are open. Apart from Mumbai and Hyderabad, we have also a large presence in Bangalore. We have opened a branch in Pune, and we have also opened in a branch in the Gift City. So we're definitely looking to invest, because from the pure the quality of the talent that we find in India, the support the firm globally is absolutely outstanding. And even from one of the businesses that I'm co-running, which is global banking, we are looking at expand further our presence in the country, both in terms of bankers covering clients and also resources supporting us globally.
So, given that you're running global banking, Filippo, talk to us about prospects for 2025. I mean, which region, just one in particular, will do the best next year?
Look, my heart is in Asia Pacific. My family still lives in Hong Kong, but I'm now the CEO of Europe, Middle East, and Africa. So it's a tough question between the two. I hope both do very well. Let me put it this way.
The loyalty should always be with Asia. Filippo, always a pleasure to have you with us. Filippo Gori, co-head of Global Banking and CEO for EMEA at JP Morgan. And of course, our thanks to Maneka Doshi. Well, still to come, EQT Group's Asia chairman joins us exclusively to discuss the outlook for regional private equity here, which sectors they're looking to invest next. Keep it here with us. This is Bloomberg. Welcome back to Bloomberg Markets Asia, and here's a look at Indian markets just ahead of the open. Futures pointing to a slightly lower open, but you know what? It's a rally for the rest of Asia, and it has a lot to do with China. China trying to boost its economy and investor sentiment, coming up with creating a new monetary policy tool for the equity market. It will cut existing mortgage rates, also its 7-day policy rate. The moves on the back of recent data, perhaps casting doubt on whether China can indeed achieve that 5% growth. India, well, we're tracking that market, coming to market in under 1 minute. In terms of the reaction elsewhere, the Hang Seng currently up by more than 3%. Asia Stack going gangbusters, up by more than 4%. The Hang Seng Property Index also getting a lift on the back of the measures to support the property sector. Is it over? Have you seen the bottom? That is still the question to be asked when it comes to the China property market. Well, for more on that, let's bring in our next guest. Jean-Eric Salata is EQT Group's Asia Chair and Head of Asia Private Capital. He joins us here in the Singapore studio. Welcome to my city.
Hi.
Your reaction to what China did today, I mean, it was surprising, some say, but is it big enough? Is it enough to really significantly move the needle?
Well, thank you for having me today, and it's nice to see you again. I think the move by the Chinese government to lower rates like this is very positive for sentiment, and doing it in a substantial way is sending all the right signals. Sentiment has been extremely weak, and I think this is a move in the right direction. But there's a lot. I think there's a lot more that needs to be done to really turn around investor sentiment overall. But it's definitely a move in the right direction, and it's great to see it happening at scale like this.
A lot more to be done, like?
I think because of the disproportionate amount of savings in China that's a lot tied up in the property sector, the reduction in rates is the first step to hopefully a recovery in the property market. With the property market then recovering, that would lead to improved consumer sentiment, which would lead to hopefully improved consumer spending in the economy, which would then reignite growth. I think from a foreign investor perspective, it's definitely a positive move. But seeing that confidence in the domestic economy, seeing the confidence return to the private sector overall, and to private entrepreneurs in the economy is all part of the equation, I think.
Jean, how does China factor into your Asia strategy? You know, people talk about how perhaps when you take money out of China, you're putting it in India. I mean, how is it all factoring in?
Well, we manage a regional investment program. We're regionally diversified, and we invest across all of Asia. In the last 12 months, we've invested in 15 companies, about $16 billion of enterprise value. It's actually been one of the most active periods we've had. 6 of those investments have been in India, 4 have been in Australia, 2 have been in Japan. We haven't invested in the last 12 months in China. We continue to be active in China, but at the moment we're finding more interesting investment opportunities in other geographies in the region.
Right, so what are these interesting investments, particular sectors? What is it that you're seeing?
I think the most interesting things that we're seeing in India at the moment in particular, which is our most active market, are areas related to domestic consumption and domestic savings and the growth in domestic demand. So, for example, we bought the largest financial services company ever purchased by a private equity firm called HDFC Credila last year from HDFC Bank. It's a student loan business that really caters to the increasing middle class spend on education and going abroad for education. That was a $1.5 billion investment that we made to really carve out the business from HDFC. It's an unusual situation that we're seeing now where we're finding corporate carve-out transactions for the first time in India. These are 100% buyout investment opportunities of scale businesses that are leading businesses in the country. We also recently acquired the largest IVF business, fertility clinics business called Indira IVF in India, which is again really catering towards the growing demand for domestic healthcare spend in the country. So those are some of the themes that we like. Of course, the technology sector in India it continues to be attractive globally as a pool of talent for international IT services and the export services that India delivers globally to the whole technology sector. And then more broadly, I would say healthcare is an area that we continue to look at in India, financial services. We announced just yesterday that we've acquired an affordable housing mortgage company, a player that helps people buy their first homes in India, which I think also is a nice long-term structural trend that we see. So there's really just a lot of opportunities, and the deal flow is extremely strong in India at the moment.
Do you expect those deal flows to continue? Do you expect those opportunities to continue coming through? The reason being, if you take a look at FDI flowing into India, for instance, it's even lower than what you're seeing in Southeast Asia. There seems to be perhaps a change in sentiment somewhat.
Deal flow is very strong at the moment. We see deal flow as continuing to remain strong in India. The other interesting development, and you've been talking about it this morning, is the public market activity in India and the IPO market, which is, I think, at the moment, it's probably the second largest IPO market in the world, which is really extraordinary. If you look back, say, 5 years ago, India probably accounted for something like 5% of global IPOs. I think it's something like 30% of IPOs this year. And what's interesting about it is the amount of domestic liquidity that's flowing into the market. So it's no longer just reliant on foreign capital flowing in. It's actually the domestic institutions, the domestic individual savers. I think last month we saw something like $3 billion US of inflows from domestic savers into the stock market. And so this kind of domestic participation in the market is very healthy. It's resulting in more liquidity. It's creating a healthy financial system, and it creates a better exit environment for private equity firms like us.
Do you see any risk?
There's always risks.
Because when we spoke to FIPO, he talked about how, you know, inflation could be stickier than most people think. That's a risk for him. What risk do you see in a market like India?
That's, I think, more of a global risk on the inflation side in terms of what that leads to in terms of Fed policy and how quickly the Fed continues to lower rates. India is a very domestically focused economy, so it's really uncorrelated to what's going on in the world when you talk about, say, Fed cutting or Fed rates or even global inflation rates. India has some structural inflation that it's kind of lived with for decades. That's coming down a bit as they invest more in their infrastructure, both physical infrastructure and technology infrastructure, digital infrastructure. I think in India, what we like about it is the continuity in the political leadership and the continuity in the policy as it relates to foreign investment and investment generally. If those conditions continue, if we continue to see that sort of continuity, I think that would create a favorable investment environment. If that were to change, that would be a risk if there's a political change in the country. Other than that, I think the economic fundamentals are sound. Valuations in the market are probably high at the moment, so I think that's a risk in terms of there being a correction. But I would see that more as a short-term cyclical issue rather than a long-term structural risk.
If you take a look at the region, PE deals in Asia versus elsewhere in the world, put that in perspective for us.
I think Asia is an under-penetrated market for private equity, but it's expanding rapidly. India, we've been talking about, was maybe a $2 billion buyout market 10 years ago. This year, it was a $10 billion buyout market. In 4 or 5 years' time, we think it's going to be a $40 or $50 billion buyout market. So that market is growing, and we're seeing more buyout opportunities.
How about a market like Japan?
Japan is a really interesting opportunity that's also expanding dramatically at the moment for different reasons. So Japan is a more mature economy, but what we're seeing there is a very interesting focus on corporate governance and shareholder reforms being led by the regulators in the Tokyo Stock Exchange. So if you look at the Tokyo stock market, the government's come out with a policy that basically says they want companies that trade below book value to do something about their valuations to improve the governance, to improve the valuations of their businesses. And there are 1,000 companies listed in Japan that trade below book value. That's $1.5 trillion worth of market cap. All of those companies are potential investment opportunities for firms like ours. And what you're seeing is a lot of shareholder activist activity and activist campaigns by hedge funds and activist funds that go in and take stakes and try to agitate for change. That tends to then create an opportunity for private equity firms like us to come in as more long-term solutions to ways to resolve those issues.
Jean, you talk about how India was attractive partly because of continuity in policies. Japan, of course, on the verge of a government change, a leadership change. How do you assess that and its possible impact, and perhaps how attractive a market it is for you?
I think political change is always a risk, and it's something that we have to monitor very closely, including the U.S. election, which is coming up, which is a very significant change that's looming, as we were discussing earlier. I think the general trend in Japan is towards more shareholder-friendly, more shareholder reforms, and that seems to be quite embedded. And what we've seen is a kind of a mindset shift in Japan, a cultural change almost amongst the boards, amongst the kind of mentality of corporate leaders, where previously there were a lot of cross-shareholdings. There was a sort of a mentality of boards being not as responsive to shareholder concerns. And we've seen a big mindset shift. And as a result, you're seeing a tremendous amount of private equity investment activity in the country. I think that's going to continue to grow.
All right. Jean, thank you so much for your time today. Jean-Eric Salata, Chairman, Asia, and Head of Private Capital Asia at EQT. Let's take a look at how Indian markets are doing right now. They've been trading for about 8 minutes right now. Let's take a look whether it's played catch up. You remember that futures were pointing to a lower open. Let's do a check on where they are right now. Pretty flat. Sensex flat. We have the Nifty index currently down about 0.1%. But remember, this is a market that's gone gangbusters, among the best performers. We talk about how those inflows have been continuing. In terms of the INR, the Indian rupee, 83.5450 is the level we're looking at, flat versus the USD. So nothing to tell mom about. Well, we're awaiting the latest RBA rate decision coming up in the next hour. Australia's central bank is expected to hold rates steady today as housing costs, including rent, continue to drive inflation concerns. This is how it's looking for the ASX 200 index. Trepidation there. It is currently down by 0.3%. It is not joining the rally that we're seeing in the rest of the region. In terms of the Aussie, 68 48, and that's how it's looking for the 10-year yield in Australia. The RBA decision due in about 35 minutes, widely expected to be standing pat today. In terms of the broader market, let's do a check on how those Chinese markets are doing before we go on the back of that slew of measures to prop up not just the markets but also the economy. Perhaps a move to maintain that 5% growth target. We have the CSI 300 index inching upwards, up by 2.5%. We have CSI currently up about 2.5% as well. China's economic stimulus plan lifting stocks pretty much across Asia. That is it from Bloomberg Markets Asia. Horizons Middle East and Africa is next. Keep it here with us. This is Bloomberg.